So this presentation will provide an introduction to federal tax law. In this video, we'll provide a brief description of federal tax law. We'll talk about some of the basic concepts behind federal income tax law, the way the tax is calculated, and how the forms are organized. And with this knowledge, you'll be prepared to begin your journey on the road to becoming a Tax-Aide tax counselor. Let's look at the basics of income, deductions, and credits. Now, the most basic rule of our income tax laws is that all income is taxable, unless the law says it's not. Now, no deductions allowed, unless the law says it is. And no credit is allowed, unless there's a law that says it is. There are two basic types of income. There's taxable income that's earned, like wages and self-employment, and taxable income that's unearned, such as dividends and capital gains. This earned and unearned income may be taxed at different rates. And we also have non-taxable income, both earned income, like wages that maybe they're deferred through retirement plans like an IRA, and unearned, such as life insurance proceeds or inheritances. So what's earned income? Earned income includes all the taxable income and wages you get from working for someone else, yourself, or from a business or farm you own. So here are some examples of earned income. Wages, self-employment, long-term disability payments prior to minimum retirement age, union strike benefits, and alimony. That's pre-2019. In pre-2019, alimony was treated as income to the person who received it. Since January 1st of 2019, it's not treated as earned income. We'll learn more about the tax treatment of alimony in a later lesson. So the term unearned income refers to any income that's not acquired through work. Put simply, unearned income is any money you earn by doing essentially nothing. This is in contrast to earned income, which is any compensation received for performing a service like work. Now, there are many types of unearned income. Some people, by the way, call it passive income. These would include unemployment compensation, interest and dividends from savings accounts and so forth, gains from the sale of stocks or mutual funds, Social Security payments, benefit payments, retirement income from retirement accounts and pensions, and things like scholarships. So taxable income must be reported on a tax return and is subject to tax. Non-taxable income may need to be reported but is exempt from tax. For example, municipal bond interest. It's non-taxable in the federal return, but it's reported and may affect the taxability of other income, such as Social Security benefits. Medicare, the amount that people pay for Medicare, may be impacted as well, and may be taxable in the state return. We'll talk about that in the future when we talk about Massachusetts state tax. So publication 4012, Table A and Table B in Tab D provide examples of both types of income. Let's look at a couple more important terms in their calculations. Now, I want to let you know that the next three slides basically cover at a very high level the process of determining how much tax a taxpayer will owe or how large a refund a taxpayer will receive. So gross income. Gross income is all the income earned and unearned, not exempt from taxes. So that's where we start. This amount's also called by some people total income. Now, from gross income, we can subtract certain adjustments, such as the ones listed here: IRA contributions, deductible contributions, student loan interest, and some others. The result is called the adjusted gross income, AGI. So the AGI amount is used in many of the calculations on the tax return, and it's a term that'll be used many times in your training. Notice that adjustments are subtracted from gross income. So adjustments can reduce the amount of income that may be subject to tax. So now we've eliminated income from our gross taxable income and have determined what our adjusted gross income is. Right? Taxable income refers to the base amount that's subject to tax. In other words, the income over which the government imposes a tax. So to calculate taxable income, we start with the AGI, which we just calculated in the prior slide. There it is. Excuse me. And we subtract either a standard deduction, which is a fixed amount, or itemized deductions, which are the total of certain eligible expenses. And in some cases, we also subtract qualified business income. So the result of taking deductions from the adjusted gross income is taxable income. That's a portion of the taxpayer's income on which they're required to pay taxes, and it's based on the tax rate that's applied. But we aren't finished, right? There's still potential to decrease the amount of tax owed by the taxpayer or a taxpayer, or increase the refund to taxpayers due. And that potential is the result of applying any credits the taxpayer may be eligible for. Now, on the right-hand side, I put something there, a chart. Normally it showed the other direction with the lowest level tax rate at the bottom, rising up to the upper level. We don't have a progressive tax rate for federal taxes. We have a graduated tax rate, meaning the more you earn, the more you pay on that income. It's not like I lived in Virginia, we paid 5% across the board state income tax. Didn't graduate, it was the same, whether you earned $5,000 or $500,000. So this tax rate, I want to show you here, bear with me. If you had total taxable income of $40,000, and let's assume that those percentages are called brackets. So there's a 10% bracket, you see at the top, a 12%, a 22%, and so on. Assuming that the brackets covered $10,000 each, straight problem here, that would say that the first $10,000 would be taxed at 10%. The second $10,000 would be taxed at a higher rate, 12%. The third would be taxed at 22%, and the fourth at 24%. So I've shown below the total tax: $1,000 for the first 10,000, $1,200 for the next, $2,200 for the next, and $2,400 for the next. So a total of $6,800. So the more you make, the higher your taxable income. People will talk about their marginal rate. People will talk about their top rate. The thing to remember about this tax rate chart is that if you're in a 22% tax bracket, it says that every dollar that's in that tax bracket is taxed at 22%. People who say they're in the 22% tax bracket, that does not mean they're paying 22% on all of their taxable income. Sorry for the long-windedness, but that's something important to know. So at this point in the tax calculation process, we know the amount of tax owed, or if the taxpayer is due a refund. The tax credits can be used to offset tax liability and or increase the tax refund a taxpayer may receive. So if a taxpayer owes tax of $3,000, but has a credit of $1,000 that can be applied, the taxpayer's tax owed is reduced to $2,000. Listed at the top of the slide are some common credits. Non-refundable credits can be used against the tax liability, that is, tax owed, until it reaches zero. Refundable credits, on the other hand, can reduce the tax liability below zero. In other words, if tax credits have already offset all of the tax liability, refundable credits may be used to increase the taxpayer's refund. But what about both? Well, at least one of the credits we'll be learning about can be used as both a non-refundable credit and a refundable credit. There's just an overview on credits. We'll cover credits in more detail in a later presentation. But at this time in the process, we've determined either how much a taxpayer owes or how much of a refund the taxpayer is entitled to. So to recover, an adjustment that's applied will reduce potential taxable income. A credit applied is directly against tax liability. Yikes, that's a lot of terminology and a few calculations. So how do we make sense of all this stuff, right? How does it all come together? Well, to help understand the pieces, let's take a look at IRS Form 1040 and a few of its schedules. So these forms summarize the flow of numbers and calculations we just went through at a high level and should help us better understand the overall process. Now in the future, you'll need to understand the forms and how they're all connected so that you can explain a tax return to taxpayers after completing their return. Now remember, it's just a first look at the forms, so there's no need to try and memorize anything. Just seeing how the documents are connected, if you will, is enough for now. And we're going to look at the Form 1040, Schedule 1, Schedule 2, and Schedule 3, and how they all connect together. Let's start with the top portion of the first page of the 1040. That's the identity section, which includes basic information such as the taxpayer's and spouse's name, their address, social security numbers. Next is the filing status. Single, married, head of household, qualifying surviving spouse. You'll learn about all of those in the future. And finally are the dependents, if any, with their social security numbers and relationships. I do want to mention that this is a copy of a draft of the 2024 1040. That's why you see OMB use only right now. I wanted to provide you with the versions that you will be seeing. It's in draft form, but these should be what you're seeing, what you will see for the schedules as well as this, are the forms that you should be seeing, we all should be seeing when we go through the 2024 tax season. Here's the bottom portion of the first page of the 1040 where we start to see actual numbers. Line 1 shows the various types of earned income. For most taxpayers, it's mostly their wages. Lines 2 through 7 include unearned income, such as interest, dividends, or retirement benefits. Now, adjustments and deductions are listed at the bottom of the page. I want to point out line 8, additional income, and line 10, adjustments to income. The details for these items are on Schedule 1. Now, you can see on line 8, it says from Schedule 1, line 10. And line 10 of the 1040 says from Schedule 1, line 26. This is a common use of IRS schedules. Provide the details on the schedules and just include the summary total on the Form 1040. I also want to focus on some of the terms we mentioned earlier. Right? Total income on line 9 minus adjustments on line 10 equals adjusted gross income on line 11. Then after deductions on line 12 and 13 are added together, the result is taxable income on line 15. Is just like the high-level calculation flow we saw on the prior slides. Let's look at Schedule 1 with the details on additional income and adjustments. Part 1 lists the various additional income items, and Part 2 lists the adjustments to income. Now be aware that many of these additions, I should say, and adjustments are rarely seen and are out of scope for Tax-Aide program. You can pause the video, review the most common ones shown here in yellow. The totals for these additions and adjustments are carried forward to the first page of the 1041, which we just saw. Page 2 of the 1040 at the top of this slide begins with the tax liability, which is the taxable income from the last line on page 1 multiplied by the applicable tax rate. So the result appears in line 16, or would appear in line 16. Line 17 says amount from Schedule 2, line 3, and brings in any taxes from Part 1 of Schedule 2. Line 19 is a non-refundable portion of the child tax credit. Now, other non-refundable credits are taken in for Part 1 of Schedule 3 and included in line 20. If the taxpayer had no taxable income on line 18, nothing would appear because the non-refundable credits would have nothing to be applied to. Right. So I'm just showing the top portion of Schedule 3 with the most common non-refundable credits. After including any of the taxes from Schedule 2, we finally have the total tax amount we would on line 24. That's a lot of numbers, lines, and schedules at one time, so you may want to pause the video here to review this information on Form 1040 and the schedules to see how they link. Moving down the 1040, we come to the payments section. First is tax withholding amounts, then refundable credits, like the earned income credit and the additional child tax credit, you can see. After totaling all the payments and refundable credits on line 33 and subtracting them from the total tax shown earlier, the result is either a refund or an amount owed. That's a quick review of the 1040 form and a few of the supporting schedules. Now, as a lot of our taxpayer base is older than 65, you'll often see a Form 1040 SR, stands for 1040 Senior. This is the same as Form 1040. It's generated when at least one of the taxpayers on the return is age 65 or older. Now, all of the lines on the Form 1040 are on the Form 1040 SR. The only difference between the two forms is that the Form 1040 SR print size is larger. So as a result, this form is 3 pages long instead of 2 pages for Form 1040, but they contain the exact same information. So we'll be generating either a Form 1040 or a Form 1040 SR. One is 2 pages long, the other 3 pages. Schedule 1 is 2 pages, Schedule 2 is 2 pages, and Schedule 3, now for 2024, it's only going to be 1 page, and it's been 2 pages in the past. The lines are the same, nothing's changed. It's just that the IRS has managed to fit all of the lines onto 1 page this year. Now I'll add that the tax year 2024 versions of these forms are still in draft. All right, knowledge check. Let's do a little knowledge check on what we've discussed in this presentation. So let's ask the first question. All income is reported on the 1040. Is that true or false? That's false. Some income is not taxable, such as child support or veterans benefits, and isn't required to be reported in the 1040. Question 2. tax is calculated on the adjustable gross income or taxable income. Taxable income. So before income is taxed, some adjustments and deductions are allowed before the tax is applied. So the AGI is reduced by deductions, that's the standard or itemized, to come up with a taxable income. And then the tax is calculated, and the result is what we call the taxpayer's tax liability. 3, refundable credits can result in a refund even if the taxpayer has no tax liability. So if it's zero, they don't owe anything, they're not getting anything back, but they have a refundable credit. Do they get that refundable credit? And the answer is true. Non-refundable credits are only applied to the extent that there's a tax liability. Once you've met your tax liability using the non-refundable credit, the rest just goes up into the air. But refundable credits can exceed the tax liability and result in a refund, or if they were getting a refund already, a larger refund. So this is another kind of quick exercise. We won't do it here. I'll show you the answers, but this is to choose the form that includes each of these items. It could be the 1040 form or the 3 schedules. Don't try to memorize where they're located. It's just an exercise to become more familiar with the forms. And so here, I'll show you the answers. The red numbers correspond to the line numbers on the form where you'll find them. So unemployment compensation, Schedule 1, line 7. Earned income credit is on the 1040, line 27. Foreign tax credit, Schedule 3, line 1. Self-employment tax, Schedule 2, line 4. IRA deduction, Schedule 1, line 20. Social Security benefits, right on the front of the 1040 and 6A. And retirement savings contribution credit. So on Schedule 3, line 4. All right, we've reached the end of this presentation.